All right, what's up, guys? Thanks for coming in with us today. We got two new guests, I guess. This is the first time we've done one of these kind of webinars with Brad. So welcome, Brad, man. Good to see you. Love the bookshelf.
Thanks, Bobby. Got a lot of these real estate books behind me.
Yeah. In today's guest, we have Patrick Kappel with Compass and Kappel Realty Group. We're excited to have you here, sir. So just to dive in, tell us a little bit about your background and about yourself, and we'd love to learn from you today.
Yeah, hey Bobby, thanks for having me on. In my background, grew up like a lot of people in the Midwest, and like a lot of folks in the Midwest, I joined the Navy to go see other parts of the world. I was enlisted for 3 years, then I went to the Naval Academy. I've served now for 21 years total. I did 11 years active duty. The rest has all been reserves and Naval Academy. And when I first got stationed in San Diego in 2007, I remembered something a mentor told me back in 2002, 5 years earlier. And that mentor said, buy real estate at every duty station you go to. And he didn't say buy low, sell high. He didn't say buy a fig, buy. He just said buy real estate, period. So as a young guy in my 20s, I took that advice knowing nothing else about real estate. And I bought my first condo in San Diego when I was in my 20s. I never left San Diego as a duty station. But I did a lot of deployments. So every time I deployed, I came back with some money I saved up and I would buy new properties. So after a couple of deployments, I found myself at the age of 30, owning 3 properties already in San Diego. Stayed in the Navy a little bit longer until my mid 30s and kept on buying real estate. By the time I owned 5 or 6 properties, I realized, hey, I'm more of a real estate guy than a Navy guy. I still love the Navy, so stayed in the reserves. But I got off active duty and went to grad school at UCLA to get an MBA. I wanted it to kind of help me with that military transition and studied a lot of finance, a lot of real estate while I was getting that MBA. Came back down to San Diego and got a second master's degree, a master's of science in real estate at University of San Diego. And I started working in commercial brokerage. After a short period in that, I swapped over to residential, specializing not in just single family homes, but also 2 to 4 unit properties, because they're a very interesting beast in the real estate world. And over the last 4 years, I've gone from being an agent of one to building up a 16-person team now that closes about $10 million a month in San Diego real estate. Of course, I kept on buying too. So my wife and I, we own 8 properties here in San Diego. I've started investing a bit in syndications and just continued growth. And I just had my 40th birthday. So did all that in my first 20 years of getting out of high school.
That's awesome, man. Happy birthday. That's a great story.
Yeah.
Well, very
yeah.
cool.
Well, thanks to the mentor. Thanks to the mentor. You got to have mentors and listen to what they say. Even if you don't know what it means, just do it.
Are you and that mentor still in touch?
You know what? No, we're not. I call him a mentor. He was actually a teacher in A school in the Navy, and he was a chief. And as Brad knows, because Brad's a Navy guy as well, there's a saying in the Navy, listen to the chief. So whatever a chief tells you to do, you just do it. If a chief tells you buy real estate, you buy real estate. I'm still in touch with a lot of my mentors, but not him. But if he's listening to this, I'll never forget his name, Chief McGrath. I haven't seen Chief McGrath in almost 2 decades, but I'll never forget that name.
What a legend. I love it.
Yeah.
Well, one thing I definitely learned when I was kind of just like reading and researching about you, and like Brad was telling me, is like what makes you really so successful is like your understanding of just the market you're in, the data points that are out there, which allows you to, make educated forecasts and good decisions. And when it comes to real estate investing, investors, they're typically going for one of 2 things. I'd say, maybe like cash flow, or maybe they're actually buying for appreciation. But could you tell us a little bit from your perspective, the differences between cash flow properties and appreciation properties?
Yeah. And me personally, I lean a little bit more towards the appreciation game, and there's reasons for that, tax reasons. I always say when you invest in real estate, even if you're investing by yourself, you got a partner, a silent partner. That's not going to add a lot, but they're going to take a lot. It's called Uncle Sam. That's your taxes. So you want to minimize how much of your profits, of your revenue, you give to that partner. Another thing a lot of folks don't realize is there's really 3 forms of cash flow. And what if I told you of those 3 forms, one is taxed really high, One is taxed a little bit, one isn't taxed at all. Which form of cash flow do you want? The one probably that's not taxed at all. And when folks, so let's talk about three forms of cash flow. The one that everybody knows, monthly rental checks coming in the mail, right? That's what most people think is cash flow. But and that's taxed as ordinary income. It's highest tax rate in America. The other two ways you can get cash flow out of real estate, and two ways I love because you don't pay taxes on it. One of my favorites is cash out refi. You buy a property that might not be a high cash flow market, but it's a high appreciation market. You buy a property, you sit on it for 5 to 10 years, do almost nothing. And then 10 years later, you pull out 300K, 400K. And when you do a cash out refi, that money's all tax free. That's a cash flow event. But instead of getting 30K year over year, little by little, tax as ordinary income, you just get 300K all at one time. 10 years later, no taxes you pay on it. So I love the cash out refi. I know you guys probably do that now and then yourselves. And I love that you don't get taxed. To play devil's advocate, of course, your mortgage is going to go up because you just put more debt on it, right? But hopefully over the last 10 years, you've been managing the property right and raising your rents adequately. So now your rents are going to be more than, if not matching that delta that you got an increase. So that's the second form of cash flow, all tax free. Third form of cash flow is when you do a sale, right? And when you sell a property, as long as you've owned it over a year, the profits on any appreciated gain you have is all taxed as a long-term capital gain. And typically your long-term capital gain tax rate is going to be lower than your income tax rate. So if you're going to sell and you get hit with that lower tax rate, it's better than getting that cash little by little, month by month, getting the high tax rate. But if you're really in the game, you do something like what Brad has done. You do a 1031 exchange. And a 1031 exchange, a lot of your listeners probably know what it is, but for those that don't, you just buy an asset like real estate, it appreciates, you sell it, all your gains, you roll into a new property. And as long as you use the gains to buy a new property, again, it's all tax-free gains. You used to be able to 1031 just about anything. 1031 artwork, 1031 business equipment, 1031 real estate. Under the Trump tax law, they got rid of the 1031 for everything except real estate. And I know that, tax laws are probably going to change again here soon. But from what I've been seeing, the 1031 exchange is not on the chopping block. It's going to remain. So there's two ways to get cash out of your, let's call it a cow, your cash cow, right? And you can get it through spurts every now and then, like every few years, every 5 years, every 10 years, tax-free, or you can get it consistently every month, but high tax rate. And I prefer the spurts that come to me tax-free. And that's why I don't invest as much for cash flow. I'm not knocking cash flow. I'm just saying there's differences. And that's why I invest in that direction. One more time to play devil's advocate though, because I always like to argue with myself. Because you gotta check yourself and other people gotta check you. But people always tell me, well, appreciation's speculative, right? Here's the thing. I have always said rents are speculative too. I've always said that. And people learned that, some of them the hard way during COVID. And when you speculate on getting rent, you're speculating on one human being that you kind of know, you screened them, but you're speculating on that one human being paying you rent, doing what they're supposed to do. You're also speculating on them not losing their job. Okay, so that's a lot of speculation on one person you barely know. When you invest for appreciation, if you do it right, you're not just throwing darts at a dartboard blind. You're researching the marketplace. You know what you're getting into. You know what the 50-year historical appreciation rate is for that market. You know what the business and economic growth is for that marketplace. And if you do it right, you can really minimize the speculation side of appreciation, and you can almost turn it into a science so that you can confidently know that you're buying into a market that is going to appreciate 5%, 10%, 15% based on the economics happening around it.
Awesome. That makes a lot of sense.
Yeah.
I see you hear a lot, because you're right. Like you said earlier, most people, when they think cash flow, they make the funny mailbox money statement or getting monthly payments. And I see what you're saying. You use appreciation, but create cash flow with it. And that takes a lot more analysis. Like I'm in like 4 syndications right now, and I just, frankly, for me, I just went with people that had incredible reputations, and I had friends look at the numbers with me because I'm not a numbers guy, honestly. Like that's not my wheelhouse, and I'm learning it. But I just went for the monthly cash flow, but appreciation, I can see the value of that. And for me, I just want to replace my monthly income. But at the end of the day, I mean, I think with appreciation, honestly, it seems like there would be more upside, especially if you're leveraging it the way you can in real estate, like long term.
Yeah. Well, and Bobby, another thing I notice is three of us on this podcast were relatively young, right? And I imagine a lot of young guys. When folks are like, "Oh, I want cash flow, not appreciation," I like to kind of like turn it into a different question for them, and I say, "Look, you're in your 20s, 30s, even 40s. Maybe if you walk into a financial advisor's office and you say, "Hey, I'm in my 20s, I'm in my 30s, I want to invest in a retirement account or whatever else." That financial advisor is going to say, "You're young. You should invest in growth stocks, not dividend paying stocks." Why is that? Because growth stocks, you're going to see gains tax free. Dividend paying stocks, you're going to get all kinds of dividends coming to you. So that looks cool. You got $100 in the mail, but it's getting taxed. Once you get up to your 50s, your 60s, you're ready to retire. That's when you want to shift your money from growth stocks to dividend paying stocks. It's the same thing with real estate. At least in my opinion, when you're young, put your money in things that are going to grow your net worth at a low to no tax cost. And as you get older, shift your assets, be it stocks, be it real estate, into those dividend paying assets. So anyone who's a young person out there investing in growth stocks, but cash flow real estate, you're walking in two different directions, right? And that's why I like to walk in the same direction. I think when you're young, 20s, 30s, your goal, you have a job, your goal should be to build net worth tax-free. And then when you're ready to retire, you said you want to replace your income. Maybe that's in 5 years, maybe that's in 10 years. Then you shift all of your equity from the assets that made you a lot of net worth tax-free, and you shift it into a marketplace that is going to give you the higher cash flow when you're ready to retire. I'm retiring young too. Well, maybe not, because I love my job. But if I ever end up one day not loving my job, then I'll retire young. And then maybe I'll take some of my real estate and high appreciation markets, 1031 exchange it, like into North Dakota, my home state, or Missouri, my wife's home state, and get the higher cash flow. Yeah.
And what I like, especially about the commercial multifamily real estate that really drove me to that, is in that space, you can really force appreciation where you can't so much in residential real estate. Residential real estate is based on the comps that are around. So if you have a quadplex, it's going to be up against another quadplex that's right on the same street, very similar age. In commercial multifamily, it's based on the net operating income, which is awesome because that's something you can control as an operator. You can go in, increase the income by increasing the rents, and decreasing the expenses by being more efficient and having stuff like technology control your rents, and having those payments come through technology, making it easier for the renter to pay their rents. So you're really decreasing a lot of the expenses, increasing the income, which increases the net operating income, therefore increasing the total value of your asset.
Yeah, that's right. And the great thing about commercial, as you said, it's kind of almost easier to force that appreciation through just a little bit of work, put some new paint up and some stainless steel appliances. And the easiest way is when you buy something that has rents way below market value. That's called loss to lease, because you're losing money because your leases are way too low. And I showed an example of that in my first year in real estate. When I was working in commercial, there was an 8-plex. So not a huge apartment building, but 8 units is commercial nonetheless. And the rents were like around $1,400-1,500. Guy owned it for 35 years. And the market rents were really about $3,000 a unit. It was a block to the beach here in San Diego. And I showed an investor how you could buy this, bump the rents up to market value. And because you're going from $1,500 a unit in rent to $3,000 a unit in rent, you effectively double the value of that property. And I know guys out there syndicators that'll go out there and buy a property and do very little work to it, but just get the rents to market rent. So there's not a lot of cost going into it. Get you up to market rent, and you can sell it 3, 4, 5 years later and double the value of that building.
100%.
Yeah. Love it. Here's a question a little bit more about what you were talking about earlier, like forcing, or not forcing appreciation, but appreciation properties. Like when it comes to forecasting the appreciation and just like everything that's going on like in the macro right now. Let's talk a little bit about how you're doing that moving into the future.
Yeah, so I can give you San Diego as an example. You know, I know the San Diego market very well. It's where I work. Someone asked me the other day, like, hey, what do you know about this market? What do you know about that market? Very little, because I'd rather be, you know, a master of one than a jack of all. But what I do with the market here, and a lot of the markets up and down the West Coast near us, is I track the trends of two things: economic growth, obviously based on things like job growth, private equity money flowing in, real estate being built. And I also track demographic changes. Because let's be honest, without people, real estate's worth nothing. If we all vanish tomorrow, everything is worth nothing. So you really got to track the demographics. So I'll give you two examples, Bobby. One, we'll start with demographics. You often probably hear people say, hey, everyone's leaving California. Everyone's leaving Southern California, San Diego. The truth is, there are a fair amount of people moving out of California because they can't afford it anymore. Okay. There's some moving out that could afford it, just want to move out for whatever reason. But the majority of folks moving out can't afford San Diego, can't afford California anyway. So those folks moving out doesn't affect our real estate prices because they weren't going to buy real estate anyway. Now, the folks moving into San Diego and the folks moving into California disproportionately have these three things in common. They're young, they're millennials, they're highly educated with 4-year degrees, if not a master's degree, and they're high income 6-figure earners. So if I have 4 people leave San Diego and all 4 of them weren't going to buy real estate anyway, but I have, for every 4 that leave, I have 3 move in. Well, that's a net loss on people. But what if the 3 that move in make $100K each and they work at 6-figure jobs? They're young, they got a lot of growth ahead of them. And the 4 that moved out made $50K each. Well, we just lost $200,000 in income, but we just gained $300,000 in income. Okay, so you can't just count the bodies coming and leaving an area, but you have to look at the demographics of the folks moving in. What's their income? What's their education level? What's their age group? And again, we're really getting disproportionately replaced here in San Diego by young, wealthy, high educated folks. And I always say too, kind of tongue in cheek, that the majority of Californians that move out, the #1 state they move to is Texas. The majority of Texans that move out of Texas, the #1 state they move to is California. So I'll probably offend people when I say this, but we got a little bit of a human capital exchange going on right now. And I've got a lot of clients now moving into here from the Midwest, from the East Coast, and they're Texas too. And they're keeping their East Coast job. They're keeping their Midwest job. But these are your high earners in the Midwest, high earners in Texas that are done with blizzards, done with snow, and done with hurricanes. And they want to live where it's 70 degrees 12 months a year. So we're attracting a lot of those. Got to look at the demographics. Number 2, the economics of an area. So another example, in San Diego, our biotech boom is one of the largest in the world right now. 3 years ago, and for the last 20 years, up until 3 years ago, we'd get, about $500 million to $1 billion in VC investment in San Diego. These days, we get $3 to $4 billion a year. In the last 36 months, biotech investment in San Diego has over tripled. And we get over $3 billion now a year in biotech investment. Same story with venture capital. We used to get, around $1 billion or so VC money poured into San Diego year over year for the last decade. But ever since 2018, so the last 3 years, our VC investment is also about 3.5 to 3.7 billion. So when I see the writing on the wall, as the saying goes, and all of a sudden in the last 36 months, VC investment has tripled, biotech investment has tripled, all the major real estate developments in San Diego right now, the developments that begin with a B, billion-dollar developments, they're all biotech hubs. They're lab space, office space. That's the writing on the wall that we saw in San Francisco in the 90s when the silicon chip was starting to become the main industry in Silicon Valley. And don't you wish you could buy some San Francisco real estate at 1995 prices? So I always tell people, hey, look at the writing on the wall. Watch where the VC money is coming from, the outside money, what's coming into your area, what's your job growth. And if it's based on tech, you're in a good city to invest in. I just came from a home inspection this morning, and I always tell my clients, more important than really the property you buy, trust me, the property you buy is important, inspect it, but more important than the property you buy is the economy you're buying into around that property. That's why, again, in my home state, a home is $60,000 today. It's $40,000 tomorrow because it's going down. It's becoming a ghost town in some areas. And in areas like, San Diego and other markets I'm sure you guys invest in, you see the writing on the wall and you can project a forecast of appreciation in that area.
One of the things I like about San Diego as well, and what made it such a strong market for me, and I live here, was there was multiple industry growth. Another big industry here is military and defense, and the writing was on the wall there when our nation said, hey, we're going to focus more on China. So they're pushing more people, more ships to the West Coast, San Diego being the hub. And then we're also very huge in healthcare, education with all the universities we have around, government, and even manufacturing. We have a lot of the intellectual concepts happen here. Manufacturing happens just over the border in Tijuana, and then the products get sold back into the United States. So it's one of those mega cities, as it's called. So same thing with GrowFu. When we're looking at these different markets, we're looking at markets that have a variety of different job sectors in them, usually so that no one job sector takes more than about 16 to 20% of the overall pie, just in case there's fluctuations in that one market area. It's not set up like a Houston, which is all oil energy there, and if oil energy prices go down, the price per barrel goes down, like all of Houston feels that. So we look at markets that are much more diverse, that have a lot of different job factors in it. And we can kind of pull that data and look at it for which assets we're going to be picking.
Brad, your comment about Houston reminds me of something my real estate professor at UCLA, Professor Sussman, said about investing in locations. We were going through the big oil boom in Western North Dakota when I was getting my MBA. And he mentioned, if you invest in Western North Dakota, if you invest in real estate in Western North Dakota, you're not investing in real estate. You're investing in oil. Mm-hmm. And at the time I was like, yeah, that kind of makes sense. And then I saw it play out with some of my family members, my cousin, my sister. They bought homes in Western North Dakota at the height of the oil boom, and those homes dropped once the oil boom went away. So keep in mind, if you do invest in a market that's heavily weighted in one or two industries, as Brad mentioned, you're not investing in real estate. You're investing in that industry. And if it goes away, you're out of luck. Your property is probably going to go down. But a place like San Diego, no one industry makes up more than 16% of the total economy here. So it's a very diverse economy in San Diego.
Wow. That's cool. And you said North Dakota, you said the homes are going down in value there in your home state?
Depends on where, depends on the city. If someone wants, amazingly high cash flow, like you get just 12% cash flow right out the gate. Okay. I can show you that. It's going to be in a town called Mott, North Dakota. Have you guys ever heard of that?
No. I've actually looked at North Dakota, so that's the only reason I've heard of it.
It's a bit of a pheasant hunting town, and it's where my cousin grew up. So I'd go out there every fall to go pheasant and deer hunting. But Mott, North Dakota is like a lot of small towns in the Midwest. The population goes down every single year. My uncle ended up selling his home, had to pretty much give it away. Seriously, like it sat in the market for years and years. dropped its over to just cover the cost of selling for the most part because the value of homes go down. So another interesting fact about real estate finance and just finance in general is the return on any asset. I don't care if it's a stock, a bond, or gold, or real estate. You're going to get X return based on a couple of things. How risky is that compared to the risk-free rate in America, the 10-year treasury bond? How risky is it? And two, what's the liquidity of it? How hard is it to sell that asset when it's time to sell? What's the liquidity of it? Okay. The less liquid something is, the higher return you should get, because it's you get stuck with it sometimes when the music stops. And the more risky an asset is, the higher return you should get. A lot of time that return is going to be seen in cash flow, like junk bonds. Some people buy junk bonds knowing they're going to be worth nothing at the end of the day, but you get a little cash flow out of them. So with real estate, there is a financial equation used in all of finance. It's used with stocks and it's used with real estate. It's called the Gordon growth model. And that model for stocks is your total return, K, equals your dividend, cash flow, plus your growth, appreciation of that stock, the growth of that stock. So if I buy a stock for $100 and it pays me a $3 dividend and it gives me it's worth $104 at the end of the year. Well, 3 plus 4, that's a 7% return on that $100 stock. In real estate, the equation's the same. We just have different nouns, different names for the placeholders. K, total return, equals cap rate plus appreciation. In most places in America, East Coast to West, your K is going to equal around 9% plus or minus maybe 1 or 2. There's going to be outliers, of course, based on markets that are a lot more risky, markets that are a lot less liquid, like Mott, North Dakota. But there's reasons such as the risk-free rate and whatnot that make American real estate just have an overall return about 9%. You're going to obviously juice that return into the teens, if not higher, because you're going to borrow money at less than 9%. You look at a lot of markets and you add up the cap rate and you add up the appreciation rate in that market. And when I say the rate and the appreciation, I mean like the 25-year average, the 50-year average. You can't just look back 12 months and say, well, it appreciated 22%. It's not going to happen every day. You got to look at the long-term average of any one market. And I guarantee you that cap plus that appreciation 9 out of 10 times is going to equal a number around 9% plus or minus 1. So when you take that into account, that's why I say, where do you want your return to come from? Where do you want that 9% to come from? Cash flow? Or do you want it to come from appreciation? The answer is, like I answer often is, it depends. It depends. How old are you? Is this going to be your only source of income right now? And if you got a job, I would say, maybe go for that appreciation or forced appreciation, as Brad said. But again, not to belittle cash flow. I like a good balance. San Diego has a market with about a 4.5% cap rate, plus or minus on average. And our long-term appreciation is about 4.7 over the last 50 years. We've seen 15, 20% appreciation in the last 12 months, but the last 50 years, about 4.7.
Nice. That's insightful. Yeah. One of the reasons I'm investing into cash flow and like less risk is because I keep about 85% of my net worth in Bitcoin. I'm a long-term holder. I'm going to hold it for a very long time. Like I believe it's going to be going to like $1 million a coin. And I personally think like all these incentives, like you mentioned, 1031s used to broadly cover everything. Now it's just real estate. We see tax incentives for what is it? Opportunity zones, right? Like sell your stock. Like let's fix these parts of America. I think we're gonna see the most robust and friendly tax incentives for Bitcoiners, I believe, in the next 10 to 15 years, because that if you look at the data, if it hits $500,000, I think half of the billionaires in the world will be Bitcoiners. It's interesting, but yeah,
you need to have a conversation with Jamie Dimon. Then you need to do a podcast with him. He's the CEO of JP Morgan Chase Bank, and he came out, I think,
worthless. Yeah, a few days ago.
Just a couple days ago, he said it's worthless. That's Jamie Dimon, I'm sure. But then you got guys like Elon Musk. So
it's like wins. Well, Jamie Dimon, your bank ain't even worth $500 billion and Bitcoin's $1 trillion. Tell me what you think about that, bud.
Yeah. We'll see what happens. We'll see what happens with that Bitcoin.
But yeah, well, cool. And now I guess let's give like a little power tip just to some of the people listening as we get close to wrapping up here. But what would you tell people who are wanting to invest in like duplexes and quadplexes? Any tips or any things you could share with them? You know, maybe if they're not accredited and they just want to really get going in their real estate
Yeah.
career, what would you share with them?
You know, the number one tip is don't hold yourself back. The only thing that stops people from really becoming wealthy is themselves. You can be born into a lot of different situations, good situations, bad situations, but go out there, get an education, either self-taught, formal taught. Anyone listening to this podcast is obviously getting an education because they listen to stuff like this, but don't hold yourself back. I can't tell you how out of fear. There's really only two human emotions I've come to realize working in my business: fear and greed. Fear and greed. Almost every other emotion is a product of those two emotions. And I see a lot of people that live in fear, and that fear keeps them from buying real estate. I can't tell you how many people in the last 5 years I've spoken with that say, I'm going to wait for a crash. I'm going to wait for a crash. I'm going to wait for a crash. Never happens, right? Because the economics are telling us it's not going to happen. And now those same people are saying, wish I bought 5 years ago, wish I bought 4 years ago, wish I bought 3 years ago. Don't live on wishing you would have done something different in the past. Make decisions today, not for today, but for tomorrow. I always say, you are today the past person that you're going to be 10 years from now. And people say time travel doesn't exist. Just like, Back to the Future. I love that movie. But time travel does exist. The only caveat is this time travel machine that we're in, it only goes in one direction and in one speed. It goes forward and it goes second by second. But the cool thing is, we can right now make decisions that will change our future. And when we get back to the future in 5 to 10 years from now, we can be who we want to be because of what we did today. So don't hold yourself back. That's usually the only thing that'll hold yourself back. Get out there and buy something. And when you start out, if you're like, hey, I don't have enough money, get a job. People always say, what's the best way to start out with investing? I always say it's a 3-letter acronym. I like acronyms because I'm in the military. It's JOB. Get a job. All right. And then once you get that job, if you're not accredited, as you say, Bobby, just buy a place, buy a condo, buy a townhome, buy a duplex, live in one unit, rent the other. Unless you're living on the street, you're living under a roof. And you're either living in your mom and dad's roof, or you're living in a landlord's roof and you're making him rich, or you're living under your own roof, making yourself wealthy. Live under your own roof. That's the best advice I can give.
And I think on the fear side, to avoid that is getting the education and getting the mentors. As he mentioned, a mentor. And I got almost the same advice from a commanding officer my very first tour when I was 24 years old. And then Patrick became one of my mentors for real estate. I had a duplex, didn't know what to do with it. He talked me, through that whole process. And in the last 6 months, bought $2 million assets with Patrick out here. And then we're looking to do another 1031 now. And so from the first duplex to one of the ones that I just bought, there was like $600,000 or $700,000 of equity built up that I didn't have to work for. I didn't go.
And it's
I
not
didn't go.
taxed.
And it's not taxed. So getting that education and getting those mentors. I was talking to Patrick just yesterday night over some drinks at the yacht club, and said how do you keep getting the data that you get that keeps you informed, because that's, in my opinion, what makes him the most successful realtor in San Diego, and why I choose him for all my deals, is that he knows the data. He looks at the data. He doesn't say, oh, there's nice countertops and there's a great fence out there for your dogs. He's like, no, here's the numbers. Here's how much this place is going to appreciate. Here's the cap rate going in. Here's how much money you can make off of it. Shows me a spreadsheet. And that gives me a lot of confidence when I go in to buy, because I know I'm buying a good asset. But he said, and what struck me last night, I said, hey, how do you get this information? He said, I'm constantly on webinars. I'm constantly going to seminars. I'm constantly learning so that I could educate other people. And that's one of the things we do at GrowThru is we're constantly talking with the biggest players out there and the biggest brokerages that have they have demographic teams, and people researching big money movement. where are they putting up a Starbucks? Where are they putting up a Target? Where are they putting up a Chick-fil-A? They have professional demographers that are working those problems for these massive companies, and we just have to learn to tap into that metadata to be able to make informed decisions. You can't, as any investor, whether you're buying a duplex or you're buying 250 units, go in and be like, oh, that's pretty. Or, I like the trees outside. Or, I like the countertops in here, or the flooring, and expect to make a good investment decision. It's definitely looking at that data. And Patrick, being one of my mentors, that was the key thing I learned from him from the first deal we ever did. Was he came with data and statistics. So whenever you're looking at any investment, whether the residential multifamily or commercial multifamily, you want to be with team members that give you data, that give you information. They don't try and sell you on anything shiny or what's good looking right now.
Yeah, and to your question, Brad, like where do people find the data? So for those listening right now that are wondering, where do you get the data? There's three main sources where I get data on a real estate market, and anyone out there can get it from these three sources. One is local universities. All right, go to, one of the better universities in your area and look up the real estate department. And a lot of times they're going to, especially in this day and age of Zoom, they're going to be hosting a Zoom webinar at least once a quarter, usually. I know UCLA does, USD does, and you're going to have PhD economists, PhD real estate professors sharing information, data, charts, and graphs to paint a picture of what's to come. So look at your local university, and you might think, well, I'm not an alumni of a university. Doesn't matter. Most of these are public universities, and any human being out there can sign up to UCLA's quarterly economic forecast and watch it on YouTube. You could probably YouTube right after you watch this. Go on YouTube, type in UCLA quarterly economic forecast. You'll probably find it. The second way is through government. Government obviously collects a lot of data. There's a website called FRED, F-R-E-D. You can find a lot of economic data about the nation and geographical regions on FRED. And you can also look into your local city to find what data collection sites they have. In San Diego, we have an organization called SANDAG, which is nothing more than like a think tank to help tell our politicians what to do. You can log into SANDAG anytime, open source, lots of data about our demographics and our economy. And the third is you don't have direct access to, but you do through a realtor. And that's access to like your state's real estate association, California's Association of Realtors, or the National Association of Realtors, or even local like San Diego. And no matter what city or state you're in, you have an association of realtors. Become friends with a realtor there, and they can share with you data that is produced by the economists that work for that association. Every state association and the National Association has economists that provide us realtors with what's happening out there in the real estate market, and we can share that with clients. So that's three good sources where anyone out there listening can get data about a marketplace.
That's valuable. That's a great ending. I have one final question though, because I was talking to a developer before this, and then we'll let you jump. But with all the money printing and the monetary expansion going on, like what is it, 25-30% of all money in circulation has been printed in the last year. Yeah. Where do you see the real estate market going? I know it's not a bubble because we're not giving strippers 3 loans like we saw in the movie, right? But in The Big Short, but there's better people with better credit that are getting these loans right now. I know we're not in like the same bubble, but where do you see us going in the next 2 years, in your opinion?
In the next 2 years, and this isn't my opinion because I never give my opinion, I just give the data. So in the next 2 years, what most economists and the data is showing us is the accelerated appreciation we've seen in some cities, 10-20%. There's certain cities we're still going to see that in. I saw Phoenix, Austin, San Diego are the top 3 projections for 2022, and they both appreciated a lot. However, in the next year or two, we will likely see all real estate continue to appreciate, but not at the bananas rates of appreciation that we see in the last year or two. And we're probably going to see the appreciation continue, but start to slow down a little. We're not going to see negative appreciation. I don't think we're going to see the market go down in at least 10 years. But I can give you 2 dates. One is December. The Federal Reserve has already said they're probably going to start slowing down on quantitative easing come December, and they're going to continue their slowing down on it through June. Quantitative easing is really just the U.S. government buying mortgage-backed securities. And that's how they put money in the market. The government, as you said, has got cash out there is 30-40% higher than it was 2 years ago. And it's due to a lot of reasons. One, quantitative easing. Government buys these mortgage-backed securities. When they buy it, they put cash in the market. As they start easing back on that, you're going to see interest rates go up. So I read this article on Forbes just yesterday, in fact, and the question about in this article was, when interest rates start going up, are real estate prices going to go down? And it was a great article, and the answer at the end was no. And the reason being, we have such a deficit of housing in America right now. Not just San Diego, not just California, but in America, we have such a deficit. Guys, we build about 10 million housing units every decade in America. In the last decade, we built 6.5 million, almost half the amount we usually build. And there's no decade in the last half a century in which we built less than 9 million. And we just built 6.5 million last decade. And we have the biggest generation of humans ever to exist in the United States, millennials, now hitting first-time home buyer age, 30s. In fact, 10,000 millennials a day turn 40. Every day, 10,000 millennials. So we've got a lot of folks, a lot of demand out there, the millennials wanting to buy, crossroading the lowest supply we've ever had in American history. So irregardless of how much interest rates go up, supply and demand is the strongest factor in economics 101. And that is going to assure that we keep on seeing appreciation. Most economists are saying it's going to take over 10 years for us to build back the deficit that we've created in the last 10 years of no housing.
Wow. Huge. That's a knowledge bomb right there at the end. I appreciate that. Awesome. Anything you want to share, Brad?
Yeah, on top of that, and going back to that metadata that we're looking at, on top of the millennials coming in with the largest population ever, the other largest population, the baby boomers, are moving out of homes and moving back into apartment living. Then the Gen X, Gen Y, Gen Zers have been trending to stay the longest in apartments ever of any generation. So either they're staying at home or they're renting longer than ever. So our value proposition is people are going to need apartments for a long time. People are going to need housing for a long time. They're not going to be able to afford single family homes. So this workforce housing where rents right around $1,000 is kind of where we focus at, because the metadata says the population is going to demand that for a long time. So that gives us a lot of strength in our thesis and why we invest in real estate, why we invest in multifamily real estate, on both on the residential side for Patrick and the commercial side for Growthview. But the metadata is saying that people need houses and there's not enough of them. That's the simplicity of the equation. And, you know, I think a 10, 12, 15-year timeline till we reach any kind of building saturation where these house prices are going to come down.
Yeah, you're going to see rents go up a lot too. Just like house prices going up, you're going to see rents going up a lot.
Man. Well, Patrick, we appreciate you being here, man. I can feel your passion through the video, and just the level of knowledge you have is unlike many people I get to personally meet. So I'm glad Brad introduced us and you were able to kind of share some knowledge with our listeners, man. So thank you again.
Cool. Thanks, Bobby. I love real estate. And I always say I practice what I preach. You know, I say now's the time to buy. And I went out, and Brad knows I bought a lot of real estate in the last 18 months or so. So get out there and don't hold yourself back.
To a 1031 here soon. So yeah,
absolutely.
Practicing what we preach, and then getting into more syndications as well.
Brad had to have a baby first. He did that. He did that just this last week. So now he's had his baby. He's ready to get back into real estate.
Ready to get back on it.
Exactly. Let's go.